So let's talk about financial modeling. Who's built a financial model? That is, who's built projections, balance sheet, income statement, cash flow? A good number of people. Debt schedule, linking up, doing some revolver modeling, anything like that. All right, that's basically what the exercise is going to be here today. As investment bankers, and we'll see in a moment, oftentimes projections aren't given to us by management. Oftentimes we need to build those ourselves. We need to figure out what is a reasonable set of assumptions to use. That is, what might a good growth rate be? What might profitability margins look like? How would we expect our accounts, our assets to turn over? How frequently would we turn over our assets, that type of thing. And when we combine all those assumptions together, it gives us the ability to build income statement, balance sheet, cash flow, debt schedule, etc. All right. So bankers, private equity professionals, pretty much any time there's a transaction, someone is building a model. And it's usually the analyst or the associate getting at least the first crack at building the model. But anytime we're taking a look at selling a company, there's going to be a model put in place, usually to justify valuation. If we're selling the company, we want to be able to justify the valuation to the buyer. The buyer is then going to take that model and probably make some tweaks to it and understand what that company might look like post-acquisition. All right, so sale of a company, merger of a company. If we're raising capital, we'll probably put together a model to show how that infusion of capital affects the company's balance sheet, and then how that plays out over some period through the income statement, cash flows, etc. Can the company cover its interest expense? Can it amortize its debt? What would the returns on equity be if we're raising equity for the company, that type of thing. Leveraged buyouts, we're going to spend a lot of time on that next week. We're going to actually spend the whole weekend next week talking about leveraged buyouts. So the model we build today, we're actually going to modify next week as though we were putting together a leveraged buyout of this company A. And then any restructuring or bankruptcy, to the extent a company's debt is getting restructured, the terms of that debt are getting restructured, we would want to see how that flows through the income statement on a post-restructuring basis. Again, answering the question, can the company service its debt? Can they cover their fixed operating costs? Those types of things. And again, an analyst associate typically is taking the first shot at putting together the model. A lot of times senior bankers might be giving some guidance, or the company might be giving some guidance, or the analyst might be asking the company for guidance. What is a reasonable growth rate to use? What type of capacity does the company have? How much utilization will the company have going forward? Those types of things. But sometimes early on, let's say we go in and we're pitching, we're trying to win some business. Again, we'll talk about the pitching process in a couple weeks. But if we don't have access to management, we might have to make assumptions up on our own. Or we might have to look at equity research reports or try and find some information on the company on the internet, maybe look at credit ratings, etc., to devise a set of assumptions. All right, so those are some of the reasons we put together models. That's kind of the analyst, the associate's role in doing that. When we put together a financial model, there's a lot of different steps that we need to follow, a lot of conventions, a lot of guidelines that are useful to follow. One key step or one key tip is keep our historical information on the same page. All right, so historical balance sheet, income statement, cash flow, we'll typically spread whatever data we have or whatever data we're given, 3 to 5 years of historical results. Okay, so we'll have, and you'll see this in a moment when we open up the model and start working, we'll have 3 to 5 years of historical, and then usually it'll be separated by a dotted line, and then we'll do projections out to the right of that. All right, so we'll typically keep those on one worksheet. We'll also calculate some historical ratios and assumptions. We'll put those on a separate worksheet, usually an assumptions tab, where a lot of our assumptions are things that we hard code that drive our model. And to the extent we ever want to change the results of our model, we make changes on the assumptions tab, and it filters through to the rest of the model. Just like everything else in banking or in private equity, formatting is very important. The blue-black convention that we talked about holds here as well. Anything blue is an input, anything black is output. And typically on your assumptions tab, most of what is going to reside there will be blue. We'll be hard coding a lot of our assumptions. Most, if not everything, on our model tab will be output. All right, that is, it will be driven by our assumptions page. Clearly labeled pages. should go without saying, typically when we put together models, at some point we put them in front of the client, so the client needs to understand obviously what they're seeing. Blue, black, we talked about. Ideally, same font and letter size. That also should go without saying. Our dollar amounts, our comma, or any numerical amounts, typically 1 decimal point. For percentages, 0 or 1, just kind of depending on the situation. And another thing I'll note right now is just format as we go. Right? So set print ranges, set preferences, code everything in blue or black, set up all the formatting as you go. The last thing you want to do in banking is get to the end of your model and have to go back and spend a few hours on formatting. Right? Chances are you're not going to remember everything that you did. You're not going to be able to, you're going to have to manually trace your steps, figure out what needs to be blue, what needs to be black, set your print ranges. The last thing you want to do is spend a few more hours on that at the end. Chances are you might make some mistakes. And just like we showed you in the spreading exercise, footnote or leave comments, make sure your assumptions can be traced to somewhere. All right, if we're pulling it from an outside source, cite that source. Okay, if we're combining two numbers, maybe leave a comment telling the associate or telling whoever picks up that model what we've done to get those numbers, to get to those numbers. All right, these will make a lot more sense as we get into the model. And as we talked about earlier, one of the first things we do before we start even building projections, we need to know what historicals look like. So we'll typically spread those historical financial statements into our model. Like I said earlier, usually 3 to 5 years is sufficient. Sometimes you don't have that, so you spread what you have. But typically you'll see 3 to 5 years. If we're putting together a model on a public company, then getting that information is pretty easy, right? We go to the SEC, we download their 10Ks, their 10Qs. All the information is readily available. If we're working with a private company, we're going to have to get that information typically from the company itself. All right, they won't have disclosed that to the public. They'll have to give us those financial statements. Just like any other time we're spreading, we're going to need to make adjustments for non-recurring items. Okay, so just as we did when we spread our comps, we will also make these adjustments in our, as we spread the historical results in our model. The goal being to get the company to as close to a sustainable set of numbers as possible. What would we expect this company to do from an operations perspective, absent any one-time events? And keep it simple. I think keep it as simple as you can, I think is always good advice. Don't overcomplicate if you don't need to. All right, well, once we have the historical financials input into Excel, typically what we're going to do is calculate a lot of ratios based on those. That is, we're going to look at how quickly has the company grown its revenues historically. What has been their relationship of cost of goods sold to sales? What has been their gross margin? Because obviously going forward, if a company's grown at only 2% a year, to forecast 30 or 40% growth per year going forward might be a little bit of a stretch. Right? To forecast radical changes in their margins might be a bit of a stretch. So we use this to give a little bit of perspective as to what the company's done historically. SG&A, how much SG&A have they had relative to sales? Very importantly also, what is their operating margin? What is their EBIT margin? What is their growth rate in EBIT? Maybe what is their EBITDA margin? Growth rate in EBITDA. We'll capture a lot of those things as well. We'll look at typically what is depreciation been, either as a percentage of sales, oftentimes as a percentage of gross PP&E. Okay, sometimes we might even go so far as to put together depreciation schedules, right? Taking a look at usually each piece of fixed equipment, depreciating it separately, and then tallying all the depreciation from all pieces of equipment. Tax rates. We'll talk a little bit about interest expense and interest income later. We really focus more on debt schedules when we're calculating those items. We'll get to that a little bit later. And then any other items in the income statement, right? Other income, other expense. A lot of times, anytime you see the word other in a category on a financial statement, it's usually a catch-all for a lot of smaller items that really aren't big enough to merit their own line item. But at any rate, we do want to understand what those are. We want to understand to the extent to which the company will have those items on their income statement going forward. All right, well, we do the same thing relative to the balance sheet and the cash flow statement as well. Okay, on the balance sheet, like I mentioned earlier, we're typically going to look at working capital turnover. That is, how quickly does the company collect its receivables? How quickly do they turn their inventory? How quickly do they pay their payables? Those types of things. And if they're collecting their receivables in 30 days, historically, we're probably going to want to be at least somewhat consistent with that in our projection model, in the absence of some evidence to the contrary. Same with inventory, same with payables. There might be, just like on the income statement, there might be line items categorized as other. You might have other assets, other liabilities, and again, we'll want to understand what those are. We either want to talk to the management team or read the financial statements, the notes to the financials, get a sense for what they are and what a reasonable assumption will be going forward. CapEx, often captured as a percentage of sales. All right, so if we take that year's CapEx divided by sales, just like we did when we spread our comps, that's typically a methodology we'll use in forecasting projected CapEx. And then any asset dispositions. Is the company selling assets? Are they disposing of assets on a regular and frequent basis? And if they are, that's something we want to understand. We want to capture that in our projections going forward. Right, so those are a lot of the items relating to our historical financials. Once we understand those, once those have been spread, now we can actually start putting together assumptions for the future and actually putting together financial projections as well. So if we're talking about the income statement, typically on the top line for revenues, a lot of times what you'll see is just like we did yesterday in class, just like you did for homework, we'll assume some growth rate in revenues. Revenues are going to grow 5% a year, or 10% a year, or 2% a year. Really just depends what's relevant in that case. That's about the most simplistic assumption we can make. And I mentioned it yesterday, oftentimes we might go a little bit deeper. We might say that, say for a producer of steel coils, we want to forecast, not just overall revenue growth, but how many steel coils are they going to sell? What will the pricing be for each? How will that change over time? And we're putting together a more detailed calculation of revenues. All right, we've got an example for a restaurant chain as well, really thinking about what are the key drivers of revenues and how will those change over time. All right, I actually did it was a litigation matter a few years ago. We modeled an air cargo company and we actually modeled each plane, its utilization, its price per ton, that type of thing, the routes that it would fly, the number of miles that it would fly a year, and we modeled based on that. We did a very detailed build-up approach of revenues. So you can get pretty granular on these types of things. On cost of goods sold, a lot of times it might be just like revenue with a straightforward assumption, it could be a percentage of sales, but it could also be, obviously in the steel coil example, what is the cost per ton of those steel coils that we expect to sell? All right. And sometimes cost of goods sold might have some, not just variable costs, but also some fixed costs associated with it. All right. So no matter what the volume is, there might be some fixed costs. If that's the case, if there's a fixed variable equation, we'd want to understand that as well. Depreciation, like I said earlier, can be calculated as a percentage of gross PP&E. That's what we're going to do in our model today. But again, it can also be based on a detailed depreciation schedule. The air cargo case that I worked on, we not only modeled the revenues and the costs for each plane, we also did a detailed depreciation schedule for each plane as well. And depreciated those. We figured out when would they be purchased, over what period would they be depreciated, and we'd build up depreciation based on those schedules. Any questions so far? Really just walking down the income statement. SG&A, in our model, we're going to assume SG&A is going to be a purely variable component. It's just going to be a percentage of sales. So as sales rise, SG&A will rise. As it falls, SG&A will fall. But in reality, a lot of times you'll find that SG&A expenses may have a fixed component to them. All right, that is, the president's going to get paid their $10 million salary no matter how much the company sells. All right, so that would be more of a fixed cost, and we'd want to model that and understand that as well. Now when we get below the EBIT line, when we start talking about interest expense, interest income, these are items that we're going to calculate in a debt schedule. That is, we're going to model each individual piece of debt, figure out how much the company's borrowing or repaying, figuring out how much interest is going to be paid on each piece of debt. We'll do that in a debt schedule. We're going to get to that a little bit later. And as I said earlier, other items, we need to understand what they are, and we need to understand how those are going to play out during that forecast period. All right, so sometimes we might just assume other income, other expense might be zero. In some cases that might make sense, but at the very least we want to understand what those items are and understand what the good assumption, what the right assumption is to make. Taxes, usually we'll assume some tax rate, 35, 40%, 38%, what have you. But if a company does have net operating losses that they can carry forward to offset future taxable income, you'd want to understand that as well, understand how they intend to use those NOL carry forwards. And you see that a lot with small companies that have lost money for the first few years of their existence. Once they start making money, they can offset that income with prior losses. Now on the balance sheet, if we walk straight down the balance sheet, our cash position is not really something we explicitly forecast. It's going to come out of all of our other projections combined, and it's going to be really closely related to how we model our revolving line of credit, our borrowing and repayment needs and opportunities. We'll talk about that a little more when we get into the debt schedule itself. But receivable days, the receivables inventory typically are based on assumptions of turnover. That is, how many days will the company take to collect its receivables? How many days will it take to turn over or sell its inventory? Those types of things. Other assets might be, it might just be a case where we assume zero, might be a case where we assume a percentage of revenue, really just depends on what they are. And then finally, goodwill. Remember we talked about it, I think in the first day of class, but goodwill can no longer be amortized. It's booked on the balance sheet, and then it's tested annually by the accountants to see if there need to be any impairment charges. Some intangible assets, notably financing fees these days, still can be amortized, but most other deal fees, we'll talk more about this when we get into leverage buyouts, can no longer be amortized. PP&E, when we talk about the fixed assets of a company, this is going to relate to obviously how much the company is spending in terms of CapEx. So we take the prior year's PP&E, gross PP&E, we add CapEx to that, we subtract any asset sales, it will give us this year's gross PP&E. And from that, we typically deduct accumulated depreciation, cumulative depreciation, to arrive at net PP&E. On the liability side, accounts payable, just like accounts receivable and inventory, we're going to model this based on an assumption of how quickly, how many days it takes the company to pay its vendors. All right, so we'll typically use an accounts payable activity ratio, accounts payable days, accrued liabilities and other. Sometimes these can be zero, sometimes these can be a percentage of cost of goods sold. Really just depends on the situation. All right, and then when we get into debt, again, we're going to talk a lot more about that when we get into the actual debt schedule itself. Each piece of debt gets modeled separately. And then finally, shareholders' equity. Everybody should know what retained earnings is. We take last year's retained earnings plus any net income that we've earned this period, less any dividends. It'll give us this year.